Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo. The Option Block is sponsored by Options Express. When a broker emerges to lead an industry like Options Express, it's only natural to want to join them. Options Express has excelled with powerful technology, an innovative platform, and exceptional customer service. Others wonder what they'll do next. Stocks, options, and futures all in one account. Visit optionsexpress.com/OXradio for your free account. Options and futures involve risk and are not suitable for all investors. Please read the characteristics and risk of standardized options and the risk disclosure statement for futures and options, both available by calling 1-888-280-8020 or visiting www.optionsexpress.com and clicking on the Risks and Policies link. Options Express Inc. makes no investment recommendations and does not provide financial, tax, or legal advice. The views and opinions expressed on the Option Block are not those of Options Express or the Options Insider Incorporated and are strictly provided for educational and informational purposes only. Any mention of specific stock options, futures, or other investment products is not intended to portray a recommendation to buy or sell a particular security. Options Express Incorporated is a member of FINRA, SIPC, and NFA.
Welcome to this week's episode of The Option Block. I am guest hosting this week. This is Mike Tusaw from Know Your Options. Mark Longo and Mark Sebastian are out on assignment this week, so it is a joy to have you with us as always. And we have a different, somewhat the same, somewhat different cast of characters today on the show. The first guest that we have, as Mark would say, we try to drag people kicking and screaming into the show. The first guest that we have today is Craig Severson of the Option Linebacker. Craig, how you doing today?
I'm doing good, Mike. How are you doing?
Doing well, doing well. How are things at the Option Linebacker these days?
We're just filling out our brackets today. That's the most important thing.
That's right. Who's your pick to click in the tournament?
Oh, it's got to be Ohio State all the way.
Okay, we have a Buckeye in the crowd. That's wonderful. Watch this. This is what you do with Buckeyes. O-H.
I-O.
Yep, that works every time. It works every time. Also, we have with us today a very special guest, his debut on the Option Block, my mentor, my friend, my old boss. We have Joe Cusick, the VP of Education at Options Express. How are you today, Joe?
I'm good, Michael, and this is about the only way that I would get on this show is if you were doing it. But, no, I've done stuff with Mark, so I appreciate the opportunity.
Good thing. It's good to have you, Joe. And also we have in the rotating chair of Options Express today, we have Rob from the trading department. How are you doing today, Rob?
I'm doing good, Mike. How are you?
Pretty good. I imagine it was a busy day today with the markets doing what it did. Were you guys keeping busy on the trading floor today?
You know, it was kind of a very busy day at the very beginning of the day with everybody scrambling around with the Nikkei down, about 8% overnight, and then things kind of leveled off and cooled off, and back to the usual grind, the grind that we've been seeing lately.
Okay, well, very good. Well, let's obviously that's the big story in the marketplace today. So let's start with that.
The Trading Block.
What are your guys' thoughts on Japan and how this is going to affect the marketplace?
Mike, it's Joe. I mean, one of the things that you got to look at here is that, first of all, people are just basically trying to wrap their heads around, not only what are the implications financially, but just when you look at the country itself and the infrastructure that has just been decimated. Watching the situation with the nuclear power plant, and seeing if that containment is now exposed, and what are the long-term ramifications of this, and that's next to impossible to discuss now. Short-term, what you're basically doing is you're looking at the industries specifically that are going to be impacted by that, and obviously uranium and infrastructure providers for nuclear power plants are the ones that you want to look at. And Cameco is one of the biggest ones. It was actually right before I jumped on the show. I was listening to their conference call, and the symbol is CCJ, and it just believes that right now they feel that they don't expect a humongous material impact from the Japan catastrophe at this stage, and it believes that a build out of reactors will continue as planned. And this is a very important point. There's going to be a lot of headlines, and you're going to see a lot of things as investors and traders. While it's very important to understand that emotion, you have to control it. And when you look at the business, and we saw a lot of activity in this particular space in those basic resources, basic materials areas today, especially in the options side, which will either be unusual or heightened implied volatility. You got to measure that with, do I hold that? Do I have exposure into that sector? What should I be looking at both in the short term and long term? On that sector then, and where are the outlets, whether it's looking at uranium stocks and hedging them or going out and looking to trade them a little bit more actively in this environment, or do I just step back, stay away from it because it's just too much of a volatile situation? And I think that's what a lot of traders that are focused on the markets and market watchers were focusing in on is, what are we going to do here? Because when you look at this market technically, this market has been kind of, as Rob had pointed out, grinding, but the signals came in from a technical perspective that the bears were starting to gain some ground. We saw that with the S&Ps, which is what I primarily watch and trade. Just kept banging its head after it got up to that 1340 level, pulled back and just banged its head. And you saw that grind basically from the end of February into March, and now you're seeing that the headlines as of late and the last 2 weeks have just given those week longs and longs in general that have had substantial profits to take them. And that, again, is another thing that we have to discuss and keep an eye on as traders.
Well, let me ask you this too, Joe. I know, like in Q6 Corner, the 1300 mark on the S&P was that's no longer anymore, and that's, I know, one thing that you had told us in Q6 Corner to really keep an eye on. What are your thoughts now with it actually? We've had our close below 1300 on both the SPX cash and the E-mini futures contracts. What are your thoughts right now in terms of us being below 1300, or what are some of the next levels of support and resistance that we may want to consider?
Yeah, it's definitely signaled off at this stage that we're in a short-term bear condition. I mean, the bears have taken the momentum and they've stuck with it. The next level that you want, the critical level that you want to watch, is that 1275 level. And I think Rob can chime in a little bit after I back off and in discussing this. But that's a critical level that you want to watch. But at this stage, Mike, as far as saying that midterm, one of the critical things going into the weekend was watching that 50-day moving average universally get banged out. And, another thing that you got to take a look at after it breached that 1300 level, and what the market did in general across all three of the major indices, which is the Dow, the NASDAQ, and the S&Ps, was that they had, first of all, especially the NASDAQ actually signaled this early. They had 5 distribution days where the volume on the down days was at its height. And when you look at basically the last 30 days, which for IBD followers is a sign of trend change, and the overall uptrend is still intact. I mean, I don't want people sitting there panicking like they have to dump their portfolio, but the bulls have control right now. There is headline risk. We had some economic data last week that came out that was signaling. You were looking at the claims and and some of the employment reports that were coming out, and with the dollar again, and this potential situation of a slowdown with rates and inflation coming into play. And Mike, I tell you, there are so many pieces to this that I've been preaching. More importantly, in the corner for the last 2 weeks. Since the end of February, protection is cheap, and you should be looking at that, whether it's overall market protection with the indices or ETFs, or you're looking at the individual securities that you have in your portfolio, and you're not ready to dump them. You can take those, you can put a put position on, maybe a covered right, something of that nature to just mitigate some of this risk that we're looking at and going forward.
Yeah, I think that's interesting in that it feels like a bear market, even though the market really hasn't gone down that much, just because of the fact that the market's gone up so much. It's an insane thing.
And that's going to do it for the trading block. Up next, the interview block.
The interview block.
And welcome to the interview block, everybody. We have a special guest with us today. We have Craig Severson from the Option Linebacker. Craig, how are you today?
I'm doing good, Mike.
Very good, very good. Now, Craig has been a longtime friend of Know Your Options. He's worked with our company for many years, and we're excited to have him with us today. And a lot going on in the markets today, to say the least. Would you agree with that, Craig?
Oh, well, finally we're getting some volatility into the markets where it seemed like it was just a one-way freight train for a while.
Yeah, it was something else to where we had the VIX as low as it was, but now the VIX is starting to come around a little bit. Can you tell us a little bit about some of the trades that you're doing right now with your clients, with your personal account, and how are you reacting to this market pullback today?
Well, we've anticipated this pullback for some time now because we do a lot of fractal market analysis. In other words, we do a top-down analysis from the monthly to the weekly to the daily and then to sub-daily charts. And what we noticed about 3 to 4 weeks ago was that we had an extreme on the weekly chart that we hadn't seen since 2003, the rally out of that recession that we had in early 2003, as well as 1999. So we were hitting some extremes on there. So about 3 weeks ago, we said we are destined for a sideways to pullback, which is exactly what we've seen right now. So we're in kind of a weekly consolidation pattern right now, which appears to everybody as though it's, we're Armageddon right now, if you're used to the market going straight up. But if you're anticipating something like this, it works in perfectly. So we're actually hitting it pretty hard right now with non-directional trades, Mike.
Yeah, it's amazing. It's like the market continues to just go up and up and up, and then it goes sideways for a while, and then it was going up so much. It's amazing. The feel for it now is so much fear in the market because it's not going straight up anymore. Everyone's panicking. Even though we're not going down too much, everyone's panicking because we're not going straight up. When you said that you had anticipated this, what do you typically look at in your trades? Are you watching RUT? Are you watching the S&P? Are you watching individual stocks? Or what are some of the arenas with which you like to trade?
Oh, we're big-time S&P 500 chartists. So really, that's when we started this service 6 years ago, we were looking for just 1 or 2 charts to really play just about every day. And the S&P has not disappointed over that time frame. It has really been the best chart that we found to trade, as well as having the options chains, whether or not you're going to use the full SPX or the XSP or the SSO or even just the spiders to trade from. So we get about 90% of our trades just off the S&P 500.
Oh, very interesting, very interesting. Now, it's a sideways market. Are you guys doing iron butterflies right now? Are you doing condors? Or what are some of the sideways trades that you guys are doing right now?
Well, we use what we call a vertically integrated pyramid strategy. So if you think about the pyramid and the shape of the pyramid, the foundation of it is going to have the largest area hitting the ground, and that's what we use with the non-directional index trades. And generally, we're using iron condors for those, but anytime you use iron condors, the thing you have to be careful of, especially if you're using the high probability iron condors, is something that's near and dear to your heart, Mike, which is risk management.
Very much so. So what are some of the ways with which you would manage risk? Because if you're using, obviously, the higher probability condors, you're going to get less premium for them month in, month out, and they'll work very well, but the 1 month that you get the event that who could have possibly predicted, as they say. So, Craig, what are some of the ways with which you guys manage risk when it appears that the storm is coming?
Well, first of all, you have to assume that the storm is coming all the time. So you can't play defense 1 month and then take another month off, or if your defensive trades didn't work out 1 month and then you say, well, I'm not going to do these anymore. You have to do them every month. You have to expect this kind of movement. So one of the type of things that we do is we'll play gamma hedges through butterflies. In fact, we'll almost turn the credit spreads into a broken wing butterfly at times, as well as we'll play off of volatility risk with Vega hedges, especially to the downside. Now, if those two things don't do it, then what we'll break out is old-fashioned delta hedging.
Okay, and by delta hedging, what would be some ways with which you would delta hedge?
Well, typically we're doing this to the upside, especially when we have these slow grinding moves that never seem to quit. We will use synthetics. So in other words, we'll just play a single contract synthetic to pick up 100 deltas by selling a put and buying a call at the same strike in the front month.
Very interesting, very interesting. Now, let's get back to Vega hedging a little bit. You say you sometimes Vega hedge to the downside. Does that mean you try and get a little bit more long, you try and neutralize the position Vega within the overall Condor position, or do you go to other underlyings? Or tell us a little bit about how you like to Vega hedge.
Well, Vega hedging is just really simple. We'll look for rallies where we have very low implied volatility, and we'll proactively pick up some long puts, typically in the front month, and sometimes, though, in the back month, depending on how we're building the positions. But by being proactive when the options are cheap, we find that it provides us, in other words, as an example, last year we picked up some of these Vega hedges about a week before that May 6th flash crash that we had, and we were able to do very, very well while everybody else was tearing their hair out. We did just fine on that particular day.
Well, that's interesting. So the concept then is then by going long the puts, should the market pull back, not only will you benefit from the increase in put delta, or whatever you want to call it, from the market coming down, but you'll also benefit as more fear comes into the market to where the implied volatility in the put option would theoretically increase. Am I correct in that assumption?
Yeah, it's an amazingly effective trade, not only from the fact that it's long Vega, and it's explosively long Vega, as well as the fact that the delta of the put itself is just increasing. But it's those facts when they both go together that makes it such an explosively effective trade. Conversely, if you hedge with calls to the upside, it doesn't typically work out that well because you have the implied volatility crush going against the value of that long call. But for puts, it works great.
Yeah, it is. You're right, because of the inverse relationship that often exists. Now, of course, just for the listeners out there, that's not going to work every time, obviously. Sometimes the market can go down and volatility can remain constant. But a lot of times that has been the case with my experience, and a lot of traders do agree on that. I know from one of our personal experiences at Know Your Options with some of the collars that we had on the day of the flash crash, there were positions that were intended to be long, and we ended up making money during the flash crash just because implied volatility on our protective puts exploded to just such insane levels that day. It was a crazy phenomenon. So I can only imagine with what you do, Craig, that has to happen pretty frequently when the market does correct violently.
Yeah, and it was funny because we had just said about a day or two before that, saying that we did back testing on the Vega hedges, and we noticed that when we did have one of those black swan events, that you have to act that day during the movement to be able to capture the value. Otherwise, it's typically gone after that.
Yeah, it's one thing. It doesn't seem to last very long. A lot of people like to get in and get that Vega and go with it that way. Well, Craig, is there anything else that you'd like to tell our listeners about in terms of where they can go to learn a little bit more about the option linebacker, or any events that you're doing, or anything that you have going on?
Well, we have a number of low-cost educational products out there that if you want to learn how to use options in a very defensive and conservative manner, that are available through the website at optionslinebacker.com. We also have a 5 times a week newsletter that includes a daily video discussing what's going on with the market, where we are with our positions, what we're doing with our positions the next day. And we use a vertically integrated options strategy that starts off with non-directional trades and tapers off in terms of our money management until we're actually getting into some of the weekly option trades that are the high-risk, high-reward type of trades. So we have a vertically integrated strategy across this so that there's no one market that works for what we do. We sort of work with any kind of market that's out there.
Very good, very good. Well, Craig, thanks for coming on the show today. We always appreciate having guests, and we'd love to have you come back sometime.
Okay, I'd love to be back again, Mike. Thank you.
You have a great day.
And that's going to do it for today's episode of The Option Block. A very special thank you to all of our guests. And shout out goes to Mike Tusaw for helping out while Mark and Mark are on the road. And special thanks to our listeners for downloading and streaming our podcasts. And we'll see you next time on The Option Block.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.